You're scrolling on your phone, you turn on the TV, you're just trying to live your life. And there it is again, that phrase, the Fed. You hear that, the Fed raised interest rates, or the Fed is fighting inflation. It sounds incredibly important. It also sounds incredibly complicated and, let's be honest, a little bit boring. You hear these terms and you're supposed to care. But nobody ever really stops to explain what it all means for you. What does any of this have to do with the price of your coffee or your rent? Well, what if I told you that the secret to understanding the most powerful financial institution on the planet is actually simple? In fact, all you need to do is imagine that the entire U.S. economy is one single car. This isn't just any car, this is the big one. It's the car we are all riding in. And our collective goal is simple. We want it to move forward at a nice, smooth, steady speed. Not too fast, not too slow. And the driver, the person with their hands on the wheel, that is the Federal Reserve, the Fed. Their one and only job is to be the designated driver for the entire economy, keeping this incredibly powerful machine from crashing. So what controls do they have? Forget a normal dashboard. The Fed is watching two main gauges. The speedometer measures economic growth. When it's in the green, businesses are growing and people have jobs. The temperature gauge measures inflation. When that's in the blue, the prices of everyday things are stable. To control the car, the Fed uses two pedals. The gas pedal, to make the car go faster, is lowering interest rates. And the brake pedal, to slow the car down, is raising interest rates. That's it. That's the entire control system. So let's see it in action. Okay, scenario 1. The car starts to slow down. It's sputtering. The economic growth speedometer falls into the danger zone. We call this a slowdown, or worse, a recession. People are losing their jobs, businesses are failing, and everything just feels stuck. The Fed sees this happening and knows it's time to act. They need to get the car moving again. So they press the gas. They lower interest rates. This is like putting the entire concept of money on a massive sale. When interest rates are low, borrowing money becomes cheap. All of a sudden, that mortgage you were thinking about looks way more affordable. Business owners who wanted to expand see that they can get a loan without crippling payments. So they decide to build that new warehouse and hire more people. This wave of spending and investment from everyone, from families to giant corporations, is the fuel that makes the economy car speed up. For your wallet, this is fantastic news if you need to borrow. It's the best time to get a car loan or a mortgage. But what happens if the driver keeps their foot on the gas for too long? The car goes too fast. The engine begins to whine and overheat. This is inflation. It's that silent thief that creeps into your life, making your gallon of milk cost more, your tank of gas more expensive, your rent check bigger. It means there is too much money chasing too few goods, and everything gets ridiculously pricey. It's unsustainable. The Fed sees the temperature gauge screaming into the red, and they know they have to cool the engine down before it explodes. So they do the only thing they can. They hit the brakes. They raise interest rates. Hitting the brakes makes borrowing money expensive again. That mortgage rate suddenly jumps. The interest on your credit card balance? Yeah, that skyrockets. Because it's so much more expensive to borrow, people and businesses slam their wallets shut. They stop spending. They put off buying that new car. They delay building that new office. This collective slowdown is what allows the overheated engine of the economy to cool down, bringing inflation back under control. So let me be perfectly clear. The next time you're watching the news and you hear the anchor say, the Fed has decided to raise interest rates again, I want you to ignore all the complicated charts. All it really means is that the driver of the economy is tapping the brakes to fight that overheating engine of inflation. And that is the reason your credit card bill and your car payment just got more expensive. It's a direct connection. It's a constant, delicate balancing act. A little too much gas, you overheat. A little too much brake, you stall. The Fed's job is to navigate this highway, trying to give us all the smoothest ride possible. If this finally made some common sense out of a complicated topic, do me a favor and hit that thumbs up button. It really helps. And make sure you subscribe and turn on notifications because in our next video, we're going to pop the hood on this car and take a look at what a recession really is and what you can do to make sure you're prepared for one. Thanks for watching.